Okay, welcome everyone. So since it's already the starting time of today's webinar, I'm the host of this event, and we will kickstart. And for any attendee who is not a panelist, please mute your phone or your laptop. Thank you very much. So greetings, ladies and gentlemen. I wanted to first thank you all for attending today's International Series Webinar of Investing in China 2023 about QFII participation in Chinese derivatives market, hosted by us, Nanhua Futures, together with DBS Bank. And here is also the special thank to our co-organizer, Shanghai Futures Exchange, for this incredible event. Today, we're honored to have 5 panelists, each from DBS, QFII, and Nanhua. For any questions you may have during this event, please type in the chat and do remember to mention which this question goes to. Okay, so first let's welcome Ian Jin from DBS China to have the opening introduction. Welcome, Ian.
Thank you very much. Ladies and gentlemen, good afternoon to all of you, and to those who are joining us outside of the Asian continent, good morning to you. On 2nd of September 2022, China Futures Exchanges finally announced the easing of rules allowing foreign investors to invest in the derivatives market via QFII channel. And as of today, foreign investors can access to 27 futures and 18 options contracts in China's futures exchanges. And with this easing of the rules, we have also seen an increase in the number of foreign investors applying QFII, and also the number of approvals that happened in the last second quarter of 2022. As of end December 2022, there were 72 successful QFII applications, of which 29 were approved in the last quarter itself. And with CSI 300 increasing 6.9% year to date and January 2023 as compared to end December 2022, and S&P 500 increased 6.6% over the same period. What does that mean for the China capital markets? And generally, economies do expect US to further increase interest rates, as recent incidents have told us. Will China finally feel the inflationary pressure that the rest of the world went through in the past 24 months? Without further delay, let me pass on the baton to my next speaker, Mr. Nathan Chow. Nathan joined DBS in 2011 and is currently a senior economist specializing in macroeconomics for Greater China. He regularly conducts interviews through various media, providing DBS views on finance and economics. As a guest speaker, he also delivers lectures on MBA courses at University of Hong Kong and the Chinese University of Hong Kong. In his presentation, Nathan will be sharing DBS view on China macroeconomic outlook, as well as the bank's forecast for key commodities prices in the near future. And following that, we have Ms. Yiping Yang of Shanghai Futures Exchange, who will share across the investment opportunities in the global derivatives market now that China has opened up. And thereafter, Ms. Mara Wang of Nanhua Futures will explain access to China futures derivatives by the QFII route, followed by my team member, Ms. Iris Gao, who will go through the QFII application process and the services DBS offers as a QFII custodian. We trust you have enjoyed this seminar, and please feel free to send through your queries towards the end of this presentation. Over to you, Nathan.
Thank you very much, Ian. Good afternoon, ladies and gentlemen. So I think the timing of today's webinar is very good because for the macro section, we have just, we have recently upgraded our GDP projection for China. So long story short, we believe the outlook for the Chinese economy this year is going to be brighter compared to last year based on 2 factors. One of them is the government's pivot from zero COVID policy, and the other one is the major policy shift, including the property market. So all of this will definitely provide a brighter outlook, and not only to China but also for countries that depend on Chinese spending. All right. So let's move on to the first slide. So on the first slide, I have I have put up a roadmap showing the entire path of the economic recovery this year for China. So basically, what happened in the past 2 months is that we were kind of in the middle of an, we called it inevitable adjustment phase because of the shift in zero COVID policy, right? So that's why over the past 2 months, most of the economic activities were kind of weak, right? But the good news is that based on some high frequency data such as subway, such as traffic, almost for sure that the pandemic situation in major cities have already peaked. And we have also seen some green shoots over the Chinese New Year holiday. You know, people are dining out, taking tours, you know, movie box office get great numbers, as well as hotel bookings, and those prelim tourism revenues, all of them, like most of them are showing very good numbers, right? So although the, I would say the infection rate in rural areas may remain kind of high in the near term, but the big picture here is that the whole economy is, you know, finding its footing. Okay, so major activities will continue to recover going forward, and both fiscal and monetary policy will continue to support the recovery. Okay, so this is the major reason. You know, the Chinese government pivot from zero COVID policy is the major reason why we have revised up our GDP projection this year to 5.5%. Before, like earlier, we had 3%, but right now we have upgraded to 5.5%. As shown on next slide, I have also put up a table on next slide to show you the forecast numbers from major institutions, including the IMF. Next slide, please. On this, on the second slide, you can see the projections, including ours. Yeah, here you go. So, you know, just like what I said, the government's pivot from zero COVID policy is the major reason. Another important reason for our, upgrading is the policy shifts since later last year. And, you know, the numbers, you know, the economic indicators may not show that much yet, but it is quite obvious that the tone has clearly changed if we listen to some of the major speeches delivered by the senior officials, like, right? So particularly the central economic work conferences held in December, you know, that reflects a far more, not just pro-growth stance, but also a far more friendlier stance towards the private sector. The tone is totally different from the past 2 years, and some of the actions are quite frankly as well. I mean, are quite frankly different as well. So, for instance, they have said that you know, the ratification of the platform companies is now over. Doesn't mean it's not going to be any regulation, but it is going to be a more normal regulatory process, right? So, for example, Didi Chuxing, right? Didi Chuxing was allowed to take on new users on their platform. For more than 2 years, they couldn't do that. So there is definitely some positive signals there, right? And you know, a lot of examples. Another one would be, you know, the approval granted to platform companies to raise new capital, and, you know, granting more game licenses to, you know, Tencent and NetEase, you know, et cetera, et cetera. So this is sort of the new policy direction under the new team that President Xi Jinping has put in place. And, you know, the formal transition of the new team will be completed by March, and then we'll probably see more evidence of a change in policy direction by then. Okay, and actually there is already some tangible development. If we look at next slide, please, we can already see some positive signals. For instance, on this slide here, we can see corporate long-term loans, which have improved quite notably in the last couple of months, right? So in December, for instance, long-term corporate loans rose to as much as 1.2 trillion renminbi, right? So we are talking about like 250% growth on year basis. So the jump has a lot to do with the policy shift that we just have discussed, majorly come from the policy support for the financing of housing project delivery. Okay, and speaking of property market, actually there's quite a big change in regulators' attitude toward the property sector. For instance, the government has started to emphasize that the sector is an important pillar of the economy, right? And also the regulators rolled out a lot of measures to boost developers' funding. For instance, asking banks to extend more loans, and they have also lifted ban on equity refinancing so that the listed developers right now are able to issue shares. Okay, so all of this will help to, cushion the property developers' repayment pressure in the near term. And for sure, the sentiment is improving. If we look at the slide on the chart on next slide, please. I have put up a chart here on next slide, which is our DBS China Property Offshore Bond Price Index. So which has started to rebound since December last year. Okay, and we have also seen some big developers. They have started to raise fund again in the offshore market. Many of those have been absent from the market for quite a while, but recently they have started to raise fund again in the offshore market to raise, for instance, dollar bond, raise fund from issuing dollar bond. Okay, and some developers were also able to secure more credit lines from commercial banks, which is another positive development. And if we look at the credit market, the spreads for investment grade continue to narrow, which is another good sign, right? So in general, what I'm trying to say is that property developers' operating cash flows in 2023 will gradually improve, meaning there will be less defaults. Unlike last year, we have seen a lot of default, a lot of bad news last year, right? But going forward, things are going to be better, okay, based on the policy development. All right, but what is interesting is that so far, as you can see on this on the chart here, so far the share prices, the bond prices for most developers have only recovered to the levels that we've seen in August or September last year, right? So which means most of them are still like 60% or 70% below the peak that we've seen in 2021. Right? So it is sort of suggesting that confidence is improving, but has not fully recovered yet, right? And so I think what market need, what investors need, is to see a real pickup in home purchases, which is still very weak right now. Okay, so my take is that going forward in the near term, the physical housing market in China is still going to be soft, at least in the next couple of months, because COVID has, in fact, done quite a disruption to the economy and the job market in China. And those people who want to buy houses, they might want to wait and see if local government will give more incentives to attract sales. So because over the past few months, if we have paid attention to the market, some local governments have offered subsidies, some have lowered mortgage rates. So as an investor or a home buyer, they might want to wait and see if local government will give more incentives, right? So that's why I would say in the next couple of months, the housing market will continue to be kind of soft, right? But what we learned from the previous cycles is that, like the one in 2011 and the one in 2013, usually supportive policies take like 6 to 8 months to be reflected into the physical market. So it makes sense to expect the property sales, the property market to have a more meaningful turn in sometime, the third quarter of this year. Okay, sometimes in the third quarter of this year. I'm not saying there will be a super V-shaped rebound, but I'm expecting that we'll be seeing more stabilization in terms of housing transaction, home sales, and even home prices this year in the third quarter of this year. Okay, so this is my my thought about the property market in China, and as long as consumption is concerned, there will be a rebound in the near term, just like what I have pointed out at the very beginning of the presentation, based on the high frequency indicators, right? So full year growth rate for retail sales for this year will be around like 8 to 9%. Okay, way better than the 1% contraction in 2022. All right, we're going to see 8 to 9% rebound in retail sales, but it also reflects a low base, for sure, right? Okay, so on a 2-year average basis, it would be something about 4%. Well, it is still below the 8% that we've seen in the pre-COVID years, and the reason why I'm a bit modest in my expectations is that there is still quite a lot of uncertainty out there. Right. If we move on to next slide, I have put up 2 charts here. One of them is the income growth. Next slide, please. Next slide. Yeah, income growth in Chinese household. Okay, on the left. So right now, I mean, in 2022, income growth per capita was 2.9%. Is way below that in the pre-COVID era. Okay, the pre-COVID years, which was about like 6.7%. Okay, so income growth is sort of, kind of slow compared to 2019. And then if we look at the chart on the right, households' expectations of future income is still falling. They are kind of pessimistic. They are more pessimistic than they were in 2020, and also lower than during the global financial crisis. I mean, going forward, this expectation here, the index will rebound, of course, but it's this is gonna take some time to go back to the normal level. Okay, so based on this development, against this backdrop, the savings rate of the Chinese household may remain quite high for quite a while. So that's why, yes, there will be a rebound in consumption, but not a super strong one. Okay, so this is my take about the consumption market. And externally, it doesn't look too good, frankly speaking, because next slide, please. Because most of the rest of the world, especially the US and Europe, slowing down, right? So on the right here, you see our growth projections for major economies, including China, including the US and Japan and Eurozone, right? So most of them are slowing down, okay? And the fact that inflation kind of high still in the US, and so inflation has been squeezing their households' disposable income, right? The latest CPI number for the US just released days ago was higher than consensus again, and services inflation is particularly sticky. So the upshot is that it is too early to claim that the inflation battle is over, especially in the US and Europe. Okay, so inflation has been squeezing their households' disposable income. Real wages have been falling over the past 2 years, so people are sort of tightening their belts. So external demand is not going to drive China very much. I think we can agree on that. Okay, so that's why against this backdrop, I would say investment growth is still going to be very important, especially infrastructure investment in China. Okay, because it is still the most controllable way to boost the Chinese economy, and it is also beneficial for future growth. And it is not just about infrastructure investment. It also supports consumption as well, because infrastructure investment is strongly correlated with income growth of migrant workers in China. Okay, so I think bonds this year to somewhere around like 3.7 and 3.8 trillion, because local government special bond is a very crucial funding source for infrastructure projects. Okay, so the chance is high for the government to raise the quota. It will be announced in the NPC meeting to be held in March. Very soon, we're gonna know the answer. Okay, so and on the monetary policy side, next slide, please. The PBOC, monetary stance for the PBOC will remain supportive. They're gonna keep a funding cost low enough to facilitate the issuance of extra government bonds this year to finance the infrastructure projects. So the good thing is that inflation is not a very huge problem in China. As you can see on the right chart here, the latest CPI number for China is just like 1.8%, right? Compared to 6.5 in the US, compared to 9.2 in the Eurozone, right? So inflation number is not that high in China. It's not a very big concern. And the fact that the reopening will boost prices, yes, but partially offset by the retreat in global energy prices and raw material prices, okay? And China imports a lot of oil from Russia as well with some decent discounts, okay? So after taking all of this into consideration, I don't think inflation is going to be a big problem for the PBOC, okay? So the conclusion here is that the PBOC will continue to be accommodative, but don't get me wrong. I'm not saying they'll cut interest rate aggressively. The economy will be fueled by the reopening itself, and all of the previous rate cuts and tax breaks will gradually filter through. So the PBOC does not need to cut interest rates too much from this level. What I'm trying to say is that they will be able, if they want to, they can maintain the interest rate at least at this level. They don't have to hike interest rate, just like what the Fed has been doing, or the ECB has been doing. Okay, so this is the conclusion. I mean, just like what I have said, all along, the Chinese government's pivot from zero COVID policy and the major policy shift will provide a brighter outlook this year, not only to China, but also for countries that depend on Chinese spending. All right, and for instance, hotels in Thailand, shopping malls in Hong Kong, and exporters of the commodities that China consumers will, China consumes will also benefit, right? And speaking of commodities, I have put up a summary table on next slide to show our major target prices for metals. All right, the target prices for some major metals. Here we go. Yeah. So, so even though you can see the average price forecast for 2023 for major metals are lower than 2022, but we have to keep the fact in mind is that they would have been even lower if it is not for China's reopening. Okay, and we have to understand that 2022 was a year with a high base. Prices were sort of overshooting, especially in the first half of last year, because of the breaking Russia and Ukraine war. There are a lot of supply chain issues. So we have a very high base in 2022. Okay, and this year, when we enter the second half in 2023, there will be higher supply growth as well, due to the commencing of new capacity. So that's why after we will see a price increase for most metals in the first half of this year. Most of their prices will sort of, heading down a little bit, moderate a little bit in the second half of this year. Okay, but overall, metals like aluminum, copper, and steel are preferred to other metals because we're gonna understand that, for instance, metal and steel prices have been strongly correlated with macro indicators such as PMIs and OECD leading indicators. So, the recovery of the Chinese economy, for instance, the Chinese PMI will support metal prices going forward, at least in the first half of this year. And for instance, the demand will be strong as well. For instance, copper demand, right? Copper demand is going to benefit from the cyclical and structural changes as well, because the China's reopening and relaxation of restrictions on the 3 red lines for the property market, all of this development will boost demand for copper, right? And on the structural front, all of those high-tech infrastructure developments like 5G networks, AI, and data centers, all of them will boost demand for copper, as well as the rapid expansions of renewable energy capacity and the EV market, right? So I would say the copper market is expected to remain tight until the second half of this year, right? Because what we have just talked about is that in the second half of this year, the market will turn to a sort of, a surplus because of the strong supply growth in the mined and refined copper in the second half of this year. So the price increase in copper will mainly happen in the first half of this year, okay? But, because of the time constraint, I cannot go through every one of them here, but the general picture is that, most of the price increase will happen in the first half of this year and kind of moderate in the second half of this year. Okay, so this brings me to the end of my presentation. We can share more during the Q&A section. Thank you.
Okay, thank you, Ian, for your professional insight. So next, we will have Ms. Yang Yiping from Shanghai Futures Exchange introducing about Chinese futures market and products. So welcome, Ms. Yang, and you may start share your screen and your speech. Thank you.
Okay, thanks for the introduction and good afternoon, everyone. Glad to join today's webinar and thanks to TBS and Nanhua for the invitation. My topic today will be China's futures market development and products introduction. So my presentation will cover 3 parts. First is an overview of China's futures markets in 2022. Second is the opening up progress of QFII and INE, which includes the latest development of INE products and the new QFII scheme. And lastly, next step at the exchange level. So the year 2022 was a hot year for the global commodities market. The complex and unpredictable geopolitical issues, the nickel short squeeze, the lingering pandemic, all these factors add up to the huge pressure on various markets worldwide. Still, when we look at the global commodity market, the trading volume is dominated by Asia Pacific, especially China. According to FII, the trading volume of Asia Pacific in 2022 accounts for 60% of the world's total commodity futures and option trading volume. So for the first time in recent years, China's futures market experienced a year-on-year decline, both in trading volume and turnover. This is also true for many of the other markets globally. In contrast, international products in China's futures market, especially on INE, recorded very good growth momentum. In 2022, the cumulative trading volume and turnover of INE increased by 59.7% and 86.5%, making INE the only commodity exchange in China that recorded double-digit growth. Metal contracts remain a strength of Chinese commodity exchanges. 12 out of the top 15 global metal contracts by volume are traded on Chinese commodity exchanges. among which 8 are from Shanghai Futures Exchange, such as steel rebar, hot rolled coil, aluminum, zinc, nickel, etc. Energy contracts traded on Chinese exchanges also show very good growth in 2022. Shanghai Futures Exchange's fuel oil futures kept ranking number 2 by volume globally. INE's SC moved up to number 9 with its volume increased by 25.6% year-on-year. INE's low sulfur fuel oil moved up to number 16 with its volume increased by 120% year-on-year. In addition to metals and energy contracts, agricultural contracts are another strength of the Chinese markets. All the top 10 agricultural contracts ranked by volume are from China. Sheffie's wood pulp and natural rubber futures contracts ranked number 9 and 10 respectively. So currently, we have 103 products listed on China's futures market, including 72 futures and 31 options. Among that, 23 are specified domestic products accessible to overseas investors, which we also call international products. These products are underlined and with asterisk. Among the 103 products, 45 are QFII accessible products, including 26 futures and 19 options. These QFII products are newly announced last year. So now we have different channels to access China's futures market. A foreign investor can either set up a wholly foreign-owned entity in China so that it becomes a domestic client and can trade 102 products, or the investor can trade the 23 specified domestic products without registering any entity in China. And they can open account with a Chinese futures firm or an overseas intermediary or overseas special brokerage participant. If the entity is a qualified foreign institutional investor or RMB qualified foreign institutional investor, it can trade the 45 products via QFII or QFII channel. Nanhua will illustrate these channels more later. Next, let's look at the opening up progress of Sheffie and INE in recent years. We know that China's futures market started to open to overseas investors for the first time since 2018. So almost 5 years passed. How is the internationalization of the market doing? First of all, we see the international products on INE enjoy good liquidity and the market is growing very fast. Over 220,000 lots of crude oil and over 20,000 lots of bonded copper are traded every day. A large share of the average daily trading volume and average daily open interest is contributed by overseas investors, and overseas participation is still increasing. Currently, the INE market has overseas investors from over 20 countries and regions in 6 continents. As mentioned previously, despite the pandemic and geopolitical issues, the INE markets grew significantly. As we can see from the chart below, the average daily trading volume of all INE products in 2022 showed a year-on-year increase, which is a highlight both for the exchange and for the futures market. Of course, in terms of absolute number, INE market is still small, but that also means big potential in the future. In addition to our global network of overseas brokers is expanding. Currently, 3 overseas special brokerage participants and 79 overseas intermediaries have been registered with INE, covering 11 countries and regions in Asia and Europe. Singapore is the second largest destination of INE registered OSBP and OIs. Overseas investors can entrust these brokers such as DBS or entrust China's domestic futures companies like Nanhua to trade INE products. So this slide lays out the account opening routes of different access channels. Left-hand side is the domestic client account opening way. So for WFI, wholly foreign-owned entity is a domestic client, and QFII are treated as domestic clients. They can open account through a domestic futures firm member. Right-hand side of the diagram illustrates how client can open account for specified domestic products. So the client can open account with a domestic futures firm member like Nanhua or the second way is to open account and trade through an overseas intermediary like DBS, or open account via an overseas special brokerage participant directly. This table shows a brief comparison of the participation paths under the QFII channel and the specified domestic product channel. In terms of participation, participants under the QFII channel are overseas entities with QFII and RQFII qualifications, while overseas participation under the specified domestic product channel are broader in scope. So they can be overseas individuals, general corporate clients, and special corporate clients. In terms of qualification, QFII channel requires investors to have QFII or RQFII qualification, but specified domestic channel does not require such things. In terms of account opening institution, QFII clients can open account only with futures firm members, whereas domestic specified domestic products channel, they allow account opening with futures firm members, overseas intermediaries, and overseas special brokerage participants. In terms of margin currency, QFII can only use RMB, whereas the specified domestic products they allow US dollar to be used as margin. In terms of investment products, QFII and INE, we have 16 products for QFII and 5 products for specified products. Finally, in terms of the physical delivery, QFIIs are not allowed to participate in physical delivery right now, whereas for the domestic specified products, most of the institutional investors can participate in physical delivery. Here we have listed all the most of the basic information of QFII products accessible to QFIIs, including the listing exchange, contract size, trading hour, as well as the liquidity and position open interest information. So overall, these are generally liquid products and of world market interest. For more details, please feel free to visit our official website of the exchange to learn more about these contracts. So who will treat these products? They can be the hedgers with business related to China commodity market. They can be hedge fund or arbitrageurs who trade between different markets. They can also be market makers, liquidity providers, high frequency traders, etc. Investors with asset allocation needs in commodity market or China market may also participate in these contract trading. Usually, crude oil and copper are most popular products among overseas investors. So today, please allow me to say a few words about these two products. Briefly speaking, INE crude oil contract is a pretty liquid crude oil futures contract, with the underlying being medium and sour crude oil stored along the coastal area of China, distinguishing it from Brent or WTI, which better reflects the supply and demand relationship in the Far East market. Asia is the world's largest producing and consuming region for refined copper, and China accounts for 41% of global production and 51% of global consumption. So for copper, we have adopted a dual contract model. As QFII's CU contract is based on tax-included market, reflecting the domestic market supply and demand, whereas INE's BC contract is based on bonded market outside the customs border, reflecting the international market supply and demand. The dual contract model can better serve the price risk management needs of both domestic and international copper industries. We see quite a few investors do arbitrage trades between CU and BC and between BC and overseas copper futures such as LME copper or COMEX copper. Moving forward, we will continue to promote the listing of new products such as freight index futures, LNG futures and options, and low sulfur fuel oil monthly average price futures, and continue to study the possibility of listing refined oil products and so on. In addition, We will have more diversified forms of overseas marketing activities in more regions, publish more in English investor education materials, and continue to provide support to our members and various participants in our market. We believe that China's market will have a promising future. And finally, if you have any questions, please feel free to contact us, and here is our contact information. And in the bottom right corner of this page, there is a QR code for the INE mailing list. Subscribers can receive INE's monthly report and reminders of investor education events. So much for my sharing, and thank you very much.
Okay, thank you, Ms. Yan, for your helpful overview representing QFII and INE. And for next part, we have from my colleague, Mr. Myra Wan of Nanhua Futures, introducing about the opportunities and channels for QFII to trade in Chinese derivatives market. Welcome, Myra.
Thanks, Alex. Hello, everyone. I'm Myra Wang from Nanhua Futures International Department. Thank you so much for attending our webinar today. Today, I would like to share the topic about the opportunities and the channels for QFII who trade the Chinese derivatives market. Before we go deep of the topic, I would like to share about the big picture of Chinese derivatives market at first. Actually, China commodities futures already rank the most largest volume in the world in terms of the trading volumes, as well our financial futures also developing very fast. So from the first chart, we can see the global derivatives trading volumes by region. Asia is already far like bigger than other markets here, as well for the respective top 20 world rankings regarding to the trading volumes. China products holds 16 places in agriculture, 14 places in metal, 5 in energy, and 3 in precious metals here. The last chart bar, we are talking about the perspective of awareness of the Western firms in the Chinese futures market. We can see from more than 2/3 of the firms, they are already participate or interested in our markets now. From this page, I would like to go details about the 3 main ways to enter the Chinese derivatives market. The first one, of course, is our QFII. Second one is international futures contracts. The last one is WFI. Actually, it's slightly similar, like our Ms. Yang said for our previous presentation. So here I will go a bit more details. As we can see, the QFII not only can trade the commodities, also can trade the bonds, stocks, or equity, and public funds, private funds. So the QFII can benefit from the great fund flexibility with a wide range of the investment scope. And the international contracts, which is a specialist in our Chinese futures market here, the advantage is the fund can stay offshore but the investment scope is slightly limited compared with the QFII and WFI. And another advantage here is for the tax issue, we don't need to pay any tax here for the international contracts. As well, we can use the USD dollars to trade. The last one is our WFI. The WFI means you can set up a sub-company in mainland of China, then you can enjoy the full range of the products trading here. But of course, you need to follow the Chinese law and you need to pay the income tax and also the profit tax as we do here. So the definition of QFII, I believe like everyone already very familiar. It means foreign institutional investors. As I said, it's not only involved in the commodities market or futures options. So here, one thing I would like to mention is you can invest now the futures or options related private funds and private public funds. So I will talk more details of our following slides. Here is the detailed information of all the products. The yellow background products are the QFII investment scope, and the red one is for our international futures products. And all of the products are listed here in the Chinese market with trading volumes and the share market we can see. So this page is very good for the arbitrage trading firms who trade like related products in the offshore futures markets. I assume later our friend Iris from DBS will talk about the QFII process, how to apply and how to open the different accounts. So here I go to directly to our trading firm's most important questions, always concerned about the risk management at first. So in China, we have many different special exchange rules. For example, like margin rules, hedging rules, position limits, and the trading limits. For the new foreign investors, if you are like not very familiar with this, no problem at all. We can help you to set up like a course to introduce you one by one. And during your trading, we also can help you to like in time for all the margin calls and other risk management calls. The second thing you might be concerned is about the IT solution. I know a lot of trading firms out of China now trading Chinese futures and options through the Bloomberg EMX. Of course, we have it as well. We can provide the CQG, TT, ISANI, and the CTB, and we have like the leading IT solutions in China for our co-location services. Except for the risk management and IT, the next one, if you are not trading by the price driven, you might be interested in the data support here. So as we know, a lot of big data services is very welcomed by the foreign investors because you don't know the Chinese market that well. So we offer our Nanhua cloud services only for our clients. It's you cannot find it in the market because it's only shared with our existing clients here. From our Nanhua cloud services, you can easily find like majority of the Chinese financial markets information, not only limited to our futures and options here. So here I would like to introduce about asset management service, because if you are not a trading firm, you are just like a family office, or you are like asset management company, you would like to invest a bit of the Chinese derivatives market, but you don't want to trade by yourself. Then our Nanhua company can offer you the top leading commodities or like financial futures or options, private fund or public fund here in the market for you to invest. And we will match your needs at first, and we will make sure all the investment you will make interested is already proved by ourselves. Because if we found some interesting funds in the Chinese market, we will use our Nanhua prop funds to invest at first to check the stability and the capacity. Then after 3 to 6 months, we will introduce to our clients. So this is also, we work very closely with a lot of investment advisors to introduce to our like outside investors. The last thing I would like to mention is about our Nanhua Commodities Index. As already many of our friends who are familiar with Chinese market, actually, our Nanhua Commodity Index is a benchmark for investors who care about the Chinese commodities industry. So when you trade, you might always need to check about the Nanhua Commodities Index trade. And as well, we are already launched almost 20 years in the market, and you can easily find us in Wind. As well, we launched our OTC market last year. So now if you would like to just buy our Nanhua commodities indexed as your cross-asset management strategy, one part of it, of course, you also can contact with us. We will give you more detailed information about our commodities indexed. The last one is the background of our company. We are the first Asia listed futures company, and we have the largest numbers of our sub-companies overseas as a Chinese futures company here. We have our sub-company in UK, Singapore, Hong Kong, and America. So we cover the majorities of the futures exchange market globally. So it's very friendly for the trading firms who is doing the arbitrage, and as well, like we can give you the globally different information as you need it. So now I'm in the business trip in Europe now, mainly stay in France and in UK. If you are the clients who are attending our webinar in these two countries, please feel free to contact me. Maybe we can meet up for a coffee. As well, my colleague Chen, he will have his business trip in the end of February to Singapore and Hong Kong. If you're based in these two places, please let us know. We can arrange some meetups and we can talk about more details as what you might be interested with. So here is all my information I would like to share. Thank you.
Okay, thank you, Mara. So next we'll have Ms. Iris Gao from DBS China introducing what services can QFII custodian provide for DBS. Welcome, Iris.
Good afternoon, everyone. Here I would like to share with you the market overview of the mainland China capital market. How foreign investors can access the market. This page is about the history. You can see since 2002, QFII program was launched, allowing foreign investors to access mainland China capital. There is CIBM, RQFII, Stock Canai, Bond Canai, mutual recognition funds, until the internationalized futures contract. Then the major development is the unification of QFII and RQFII program. Then we call it Unified QFII. The Unified QFII is the most comprehensive program for foreign investors to access China capital markets. For the commodity futures and options, as you might know, in September 2022, as approved by CSRC, all local futures exchanges have announced a total of 41 futures and options contracts that can be traded by QFII. Next page, I will share the development of the unified QFII. The unification of QFII mainly simplify the application process and expanding the investment scope. In this page, we've listed the investment newly added after the unification of QFII and RQFII. We mark those newly added investment in red. In the right bottom part, you can see we've listed SHFI, INE, DCE, and ZCE. For now, as we just mentioned, we can trade a total of 41 futures and options contract. Next page, I want to highlight with you because it's not clear in the QFII regulation, but per our own experience, there is some window guidance from CSRC, the authority who is in charge of approved QFII application. Here, we listed the eligibility criteria set by the CSRC on QFII applicants. First, the applicant shall have at least 2 years of investment experience. Next, the applicant, the asset its net asset should be at least CNY 10 million or equivalent. The third is about the applicant's financials. The net asset divided by its paid-in capital should not be less than 50%. The last one is on the market value of the applicant's AUM if it's an asset manager, or its investment size if it's a prop trading firm. The investment size should be at least CNY 100 million or equivalent. Here, one thing to note, if one of above criteria could not be met, but is quite close, it's most likely that CSRC will still approve the QFII application. So please do not hesitate to reach us if you are not sure whether you have the chance to get your QFII application approved. On the next page, we've listed the comparison table between old QFII and RQFII and the unified QFII. The most important part is under the unified QFII, the quota management is removed, which means unified QFII could invest in China without any quota limitation. Next page, the most important thing we'd like to highlight is the unified QFII could freely choose to inject foreign currency and or renminbi. On this slide, we've listed the simplified application process for QFII applicant. You can see for older QFII or RQFII scheme, CSRC will need either 20 working days or 60 working days, but now unified QFII only need 10 working days, and the application documents are simplified. It's simplified from previous 13 items to existing 6 items. On next page, we've listed the implementation process for different scenarios. For example, for scenario 4, it's for those QFII like to invest in futures. You can see QFII application, safe registration, then appointment broker, PBOC approval on the account opening, trading ID application with respective futures exchange, then we can start trading. Next page is unified QFII account structure. You can see the account is segregated for injection in foreign currency and injection in CNY. The purpose is to avoid the arbitrage done by the QFII to on the difference of the foreign exchange rate of CNY and CNH. Next page is an overview of the closed loop circuit for margin transfer for futures trading in China. So the client could inject money from offshore account into its NIA account with QFII custodian bank. In our case, it's DBS China. Then within DBS China, the margin transfer can be done to transfer the margin from client's account to local broker's account. Then also within DBS China, the broker account will transfer the margin to exchange account. For the repatriation, it's the same way around. In view of the time, we leave our key context here on this page. If you need greater details, please feel free to approach us after the call, and we are more than happy to give you more details. Thank you for your time.
Okay, thank you,
Back to
Iris.
you.
Okay, thank you, Iris, and thank you all for staying till the very end of today's event. Although we're right on schedule at this moment. So, okay, so we have a question in the chat box stating, is there any indication of what % of these contracts is retail traders versus institutional? So, Mara, do you want to answer this question, or we can also leave this to the we can also leave this question to the via email or any other form of communication also.
Yeah, so I will just give a brief answer for this question, and for detailed information we can communicate after. Actually, there is limited to open the account for the international contracts. Not everyone can open it with a small trading volume. So based on this, for example, like the different exchange market, they ask for the funding requirements in the recent 5 trading days is different. Individuals, sometimes they need more than 500,000 INB. As an institution, they need more than 1 million INB for the funding requirements. So based on this, we assume here the institutional investor will be more than the retail investors. As well, some exchanges, they share the different products trading volume, but not that specific on numbers. Based on the open information we can find, yes, it's proved as what I said, the institutional investors are more than the retail investments here, especially for the positions they hold. Yeah, so here is the answer. Thank you.
Okay, so thank you all again for attending to this webinar. And we are always eager to share as much as possible that we acknowledge upon this great opportunity for anyone who should be interested in trading Chinese derivatives market. So here is a brief contact us page for anyone who should be interested. You can take a screenshot and leave any questions or information you wanted to check with DBS or Shanghai Futures Exchange or us Nanhua as well. Feel free to contact any of us. And thank you for attending today's webinar. We'll be leaving. Thank you.
Thank you. Bye-bye.
Thank you.